Welcome back. Earlier today was reported the New York Fed's Empire State Manufacturing Index tumbled to a 4 month low. That's a level of negative 14.5. What we're going to see in just a moment is that we may see the answer in the bond market as far as when an improvement may be seen in the manufacturing index. Now, again, the Empire State Manufacturing Index rates the relative level of general business conditions in New York State. A level above zero indicates that conditions are improving, below zero, worsening. Today, it was reported negative 14.5 following the prior month 9.1. This is the lowest low we've seen going back to August. And what we can see are the lows are much more significant than the highs. The best number we've seen this year was in April, 10.8, followed by last month, November, 9.1. But today's number, negative 14.5. We saw August, there was a level of 19. Prior to that, we saw levels near 32, 33 to the downside. So overall, the trend certainly is negative in manufacturing. Here's a historical look at manufacturing, go back to 2002, and we can see the dips along the way are pretty obvious. In 2008, 2009, we saw levels of in excess of negative 30, almost negative 40 at that point. 2015, we had a pullback to basically where we are now, negative 15 or so. Of course, we had the COVID crisis, brought us temporarily to very, very significant lows. And then more recently, and I would say quite unusually, we spent the better part of the last couple of years more or less in negative territory. The red line, by the way, is the S&P 500. And you'll notice in the past, when we've seen manufacturing slump, we've seen stock slump, as was the case in 2008, 2020, even 2015. So the question really is, will stock slump the way it has in the past compared to manufacturing? Here's a closer look at the periods between 2006 and 2010. The S&P 500 in red is chugging along, making new highs, and then the manufacturing index starts to slow. Notice the big drop in manufacturing before stocks even took a move to the downside. However, shortly after that, we saw a pretty significant span of time to the downside, maybe 8 months in negative territory, maybe even more than that, late 2008 to early 2009, that coincided with the stock market slump. Now we take a look at more present date. This is from January of 22 through present date. The red line again is the S&P 500, and this really does highlight the significant downturn we've seen in manufacturing, hitting lows in excess of negative 30 three times in 2022 and 23. Today's number is not as bad as it was back then, but then again, we want to see positive territory. And notice how sparse the positive numbers are. We really don't see a lot of positive news coming out of manufacturing, at least as of late. Now, here we see something very interesting, and this may give us the clue as far as when manufacturing will improve. The red line is a 1 year US Treasury, the yellow line is a 10 year US Treasury. Now, typically, those Treasury bonds with higher yields, like the 10 year, we expect to trade higher than our shorter term maturities, as was the case in 2021 and early 22. However, when the red line, the 1 year Treasury, crossed above the 10 year, this sparked the beginning of the inverted bond market. This occurred around second quarter of 2022. Notice how the manufacturing sector at this period of time really took a nosedive. It really coincided almost perfectly with the beginning of the inverted bond market. Now, the inverted bond market, not only does it tell us that the bond market and the overall economy expects higher interest rates to occur sooner rather than later, which in essence tells us that the market's expecting, weaker economic conditions in the long-term future. But more than that, it tells us that there is a great amount of insecurity within the markets, within the financial markets. So until we see the longer term treasury, like the yellow line, the 10 year bond, cross above the 1 year, it does show us a lack of confidence in the treasury market and a lack of confidence overall. So I know Dow Jones Industrial Average hitting new highs. That's only one index though. The treasury market is telling us we still have a terrific amount of insecurity in the market. And manufacturing is very sensitive to this. There are no small investments in the manufacturing sector, and I don't think that we're going to see any return to growth until we see more confidence, and that may be reflected in the bond market. So we're going to watch these indicators and certainly many others along the way, and we'll be sure to update you with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.